Hello, this is Josh Belk with the Belk on Business podcast. Today we're going to pick up once again on the One Big Beautiful Bill, and we're going to talk about these Trump accounts, which you may have heard a little bit about, as well as some of the changes that relates to investment in various communities. And so we'll talk about that in the second half of the podcast today. So these Trump accounts, you may have heard, while President Trump was campaigning about these savings accounts, putting $1,000 into these accounts to help young people with their education accounts. Now, the rules are out, and to be honest with you, I mean, there hasn't really been much in the way of fanfare outside of $1,000. They're probably still best if you're a parent looking to invest in your child for college, to use a 529 or even if it's, or maybe possibly even using IRAs if it's something to where not necessarily look at the education, but more for something to if the child is earning money to be able to contribute money for their retirement. But as far as it relates for education, I'm going to talk a little bit about the rules. Just kind of keep in mind that outside of the $1,000, there may not be a whole lot of benefit to receiving it. If you're an employer or the child works for an employer, there may be some benefits there for the employer that could be considered for the employee. So Trump accounts. So what it does, it allows for parents and other relatives to invest up to $5,000 annually to be invested into a child account to be used for education or first-time home ownership. So a parent can put in, or another family member can put up to $5,000 into that account. Now, if for employers, they can put up to $2,500 into the account, and so that might be more beneficial for the employer. For you as the parent or as a relative for that particular child, that contribution is not going to be a tax deduction. Okay, just gotta be aware of that. So the child, in order to have a Trump savings account, they must be under 18, and they must be a U.S. citizen, and they with Social Security number, and one of the parents must have a valid Social Security number. So kind of keep that in mind. There is no deduction for contributions. So if you go through and you put, say, $5,000 into a Trump account for your child to be used for continuing education expenses, just realize that particular contribution is not going to be a deduction for you. Okay, any sort of growth is exempt from taxation. So if the money earns, you do not have to pay taxes year over year on any sort of earnings within the account. Everything will get deferred until funds are distributed out of the account. There are no distributions allowed out of the account until the child reaches 18, at which the account is treated similarly to an IRA. So once they're 18, if money starts getting pulled out, not for qualified purposes, there's going to be an early withdrawal penalty. Okay, just like with an IRA. Okay, so the distribution must be for qualified expenses, so if you take the money out, it's used for qualified expenses. You're not have tax on all of that income. But if it's not used for qualified education, or you can take up to $10,000 out for first-time home purchase, anything beyond that is going to be fully taxed. Okay, and so what the IRS is going to do, what the federal government's going to do, they're going to put $1,000 into these Trump accounts, okay, for children, and then for any child born between 2023 and 2028, they're going to put that money into that account. And then you'll want to go ahead and kind of stay on top of that. But if you're really looking to invest in your child's education, you may really want to consider just looking at a 529 plan and not necessarily look into this wholly for helping funding for your children's education. So Trump accounts are structured like Roth IRAs. Okay, so but they do have with additional restrictions. For, like I said earlier, for parents, 529 plans may be more attractive because of flexibility and its tax benefits, and because there really isn't much of a benefit beyond $1,000 initial deposit. And then for employers, there may be some benefit there that would not be necessarily for parents. Then second for today, and this will kind of wrap things up, talking a little bit more in detail about certain aspects of the One Big Beautiful Bill, and then for next week's podcast, going to kind of run through a summary, and then we'll shift off for a short time into other topics. So lastly, as it relates to this bill, I'm going to talk a little bit about the low income housing credit, new markets tax credits, and then I'm just going to mention briefly opportunity zones that were talked about last month in podcast. So the One Big Beautiful Bill essentially phased out clean energy credits for renewable energy, clean vehicles, hydrogen, and energy efficient construction, provided clarity for investors and developers with long-term investment plans in distressed areas to encourage economic development. So once again, the whole kind of emphasis of these particular low housing income credit, whether we're looking at the new market tax credit or opportunity zones, really a lot of this emphasis is really to go into distressed areas and try to help build them up. So I think one of the geniuses of President Trump that many previous politicians did not have was an understanding that it's going to take a lot of private investment, private companies to go in, invest in communities, because government isn't going to be able to do it all. So to encourage businesses to go into these areas, invest money, and for them to receive a benefit, it really kind of is a win-win for everyone involved. So low-income housing tax credit is a credit for housing developers that maintain a certain percentage of affordable units over a specified period of time. And generally that's 30 years. There are provisions for 15 years. Not going to get into much detail on that. But if you're a developer, you're looking to either build or buy and rehab property in certain distressed areas, then there is a tax credit that you may qualify for. This program essentially is a subsidy for construction rehab of low income affordable rent housing. Okay, so what they're trying to do is encourage through these tax credits, private businesses to go through and build or rehab properties to help low income individuals. The new market tax credit is an initiative to encourage private capital investment in the low income communities. And this goes beyond real estate. So this new market tax credit, Congress authorized an amount each year that the Treasury Department allocates to qualified applicants. So unlike the previous, I'm talking about the low-income housing tax credit, this particular credit is one where you'll actually have to go to and get approval to receive the funds. So investors. So this particular tax credit initiative to encourage private capital investment in low-income communities, Congress authorized an amount each year that the Treasury Department can distribute or allocate to qualified applicants. So the investors provide capital to community development entities that are awarded credits against their tax obligations. Okay, so you can kind of think through this money is distributed, and then it allows for credit to developers to be able to reduce their tax obligations, and that credit can be up to 39% of the project taken over 7 years. So this credit isn't all taken at once; it's one that can be spread out up over 7 years. So if you're getting into an area, it goes beyond real estate. There are certain types of businesses that are excluded. But if you're going into more of a distressed area and you're looking to invest or build a business in that particular area, this particular credit may be available for you, and it'll be one that you'll want to have a conversation with your tax professional or your accountant. And then lastly, just want to kind of mention opportunity zones. And I saw the statistic, and I talked a little bit more about opportunity zones in previous podcasts. But it's kind of really interesting since, once again, this is part of the bill that's really focused on trying to develop more distressed communities. And as I mentioned in a previous podcast, you may have heard that these particular zones have changed. Kind of give you an example. We're here just out in the Chicago area. So 133 tracts in Chicago out of about 500 tracts in total are opportunity zones. Up here in Northwest Indiana, kind of our more distressed town. So here there are 156 tracts total in Indiana, and then 8 of them in Gary, which represents about 28% of the population, 3 in Hammond, and these are neighboring communities, and which represents about 14% of the population. So when I kind of look at the two kind of more, I would say, communities in our area that make that their income is lower than most of the rest of the state, most of the rest of the country, there's pretty large areas. 28% of Gary, city you may have heard of, and then another kind of a neighboring city of Hammond, about 14% of that area, the population is impacted by this. So it is one, if you're looking to invest in kind of more distressed areas, that there is more area there, and maybe something you want to look into, and something that we've seen clients really benefit from as it relates to opportunity zones. So once again, today, talked a little bit about Trump accounts and community investment, kind of last 2 areas we're going to get into any sort of detail on. Next week, we'll kind of give a high-level overview, and then maybe in the future, we may go into depth into other topics as we receive more clarity. Once again, this is Josh Belk with the Belk on Business Podcast. Have a wonderful day.